Hey everyone, welcome back to Corporate Decoder, the place where we dig into the sometimes confusing world of corporate filings. Today, we're cracking open an 8K report. Think of it as a corporate oops. We did something newsworthy announcement, and trust me, this one has a little something that might make shareholders perk up. Today, we are looking at Montauk Renewables, and they are announcing something that could be very interesting for investors, a share repurchase program. What exactly does this mean? Well, the company is saying they are going to start buying back their own stock. Montauk's board has given the thumbs up to spend up to $5 million to buy back shares. So what's the big deal? When a company buys back its own shares, it reduces the number of shares available in the market. If everything else stays the same, this can nudge the stock price up because each remaining share represents a slightly larger piece of the company. It also signals that the company thinks its stock is undervalued and is a good investment. Now, they can't just buy these shares in one go. The company has a few options on how to do this. They can buy them on the open market like you or I might buy a stock, or they can negotiate private deals to buy blocks of shares directly from shareholders. There's also a mention that they need to follow something called Rule 10b-18, which are just rules to make sure they're not manipulating the market when they buy back their stock. Who decides when and how much to buy? A repurchase committee, which consists of board members and management, will be calling the shots. This means they will be looking at the stock price, company performance, and overall market conditions to figure out the best time to buy. Now, this is not a do or die situation. The program doesn't have an expiration date, and the company isn't promising to buy back all $5 million worth of stock. The board could stop the program at any time, or they could decide to buy back even more stock later. Of course, they also have to include some warnings because everything is not always so rosy. This report contains forward-looking statements. Basically, these are predictions about the future. And as the report says, actual results could be different. What could go wrong? The company notes that things like the economy and other opportunities to invest their money could impact their buyback plans. If the economy tanks or they find a better way to use that $5 million, the buyback might not happen or might be smaller than planned. The report encourages you to check out the risk factors section in their annual report because, well, it wouldn't be a proper corporate filing without a list of all the things that could possibly go wrong. Now, what does all of this mean? On the surface, a share repurchase program sounds great. It can boost the stock price and it shows that the company has confidence in its future. However, it's not a guarantee of success. The company might not buy back all the shares and the stock price could still go down. Is this a good move? Well, it depends. If Montauk believes its stock is undervalued and it has the cash to spare, a buyback could be a smart way to create value for shareholders. On the other hand, if the company is struggling or if it has better uses for the money, a buyback might not be the best choice. Montauk is in the renewable energy business. This is a growing field, but it's also a competitive one. They're dealing with a lot of risks. This report was signed by John Ciroli, Chief Legal Officer, so the information is from an official source. So what's the verdict? Montauk's share repurchase program is a potentially positive sign, but it's not a slam dunk. Investors should keep an eye on the company's progress and consider the risks before making any decisions. Thanks for watching. If you found this helpful, please like, comment, and subscribe for more corporate decoding.